In this lesson, I'm going to take you through some key fundamentals in the subject Basic Finance. Now, Basic Finance, as you already know, is one of the subjects that's in the Zambia Institute of Marketing Certified Professional Program. A number of students, once they hear that there's Basic Finance, they get discouraged. But you shouldn't be. And I'm going to run you through some key fundamental points that will kick you off. You'll be able to answer some exam questions based on just what I'm going to present today. My name is Saboy, and my number is 0966930260. Feel free to WhatsApp me. Let's chat. I'll be happy to help you in your studies. Now, let's get straight into what I'm about to run you into. Only 8 fundamental points for now. Only 8 fundamental points to help you get started. Number 1 is you need to understand the purpose of accounting. And the purpose of accounting is so that a business can have financial information. To have financial information. What is financial information used for? Financial information is used for a number of reasons. Number 1, costing. Also, auditing. To ensure that the business is complying with set policies and set standards and set processes. Also, it is used to be able to price the products correctly. And also for investments. You see, when someone is investing in a business, they want to look at the financial statements of that particular business to see how it is performing. And this information is provided for by the very existence of accounting. Examiners may ask you why accounting exists. What is accounting for? And they'll give you answers, because that question usually comes under Section A. Section A is Section A, I wanted to say Section A is compulsory. Section A is multiple choice. There are 10 questions, and one of the questions that may be asked is, what is the purpose for accounting? So let's move to point number 2. I'm only going to run you through 8 very important points for this particular lesson. In the future lessons, we'll talk about other things. Number 2, you need to understand what is known as the accounting equation. What is known as the accounting equation. And it is as simple as assets is equal to capital plus liabilities. That is all. That is the accounting equation. And it is very important. You need to know and understand that assets is equal to capital plus liabilities. That is the accounting equation. Let's move on to number 3. Now, I'm going to begin to break down the accounting equation, and we are going to start with assets. Assets are those things that a business owns. Yes, take that. Very important. You own assets. And examples of the things that a company can own, e.g., machinery, stock, motor vehicles. The business owns these things. So these are examples of assets. Another important example of assets is what's known as trade receivables. What are trade receivables? Think of a company that offers cleaning services, and for its services it is paid at the end of the month. So today is the 20th of August. So I want you to think of a company. No, today is the 21st of August. I want you to think of a company that may have done the cleaning on the 9th of this month and is expecting payment on the 30th. Basebenza kudala ni ndalama zabo. So that's what's known as trade receivable. The business has done something, the organization has provided a service and is expecting payment. That is what's known as trade receivable. So assets are what a business owns. Number 4, liabilities. Liabilities. If assets are what a business owns, then liabilities are what a business owes. Very important. Mulinankongole as a business. So, e.g., the business may owe Nkanya loan. Okay, you would need to pay. Okay, it's an example of a liability. You owe people money. Another is trade payable. Trade payable is like trade receivable, but you're looking at it from the other end. So as a business, that cleaning company cleaned for you, and today is the 21st. You have to pay them on the 30th. So you owe. They've already provided the service. You owe them. It's a payable. That's what that means. It's a payable. You owe them, and that's an example of a liability. So liabilities really are what a business owes. Number 5. Let's talk about classification. Classification of assets and liabilities. How are they classified? These are going to be classified as current or non-current. The principle is that with current assets or current liabilities, they have to be dealt with within 12 months. So if it is current assets, okay, current assets, these must be what you can convert into cash within a period of 12 months. Examples, e.g., stock. Another example, trade receivable, which I did explain, right? I did explain trade receivable. These are examples of assets. Prepaid liabilities. Prepaid liabilities. Are you thinking that, why is he talking about liabilities when he's talking about assets? Let's put it this way. We are in the month of August 2020, and let's assume as a business you paid for rentals up to June 2021. Those are prepayments. It means that you have secured assets, you have secured space. Malipira ahead. It's yours. You are entitled to a prepayment because you have already paid for it, and therefore it is an asset. It is a current asset. Then current liabilities. Examples of current liabilities, since we're talking about current, so let me just talk about current liabilities. Again, within 12 months. And examples of current liabilities include accounts payable. I did explain accounts payable, right? I said trade payable, accounts payable. Okay, so that's but an example of current liability. Not just this, there's others. You may have gotten a loan which you need to pay back within maybe 4 months, 5 months, 9 months, 11 months, as long as it is within 12 months. So when we talk about current assets or current liabilities, it's an issue that has to be done within 12 months. Okay, or if it's current assets, you can convert what you have into cash. Cash, by the way, is also an example of a current asset. So you can put it there if you want to say cash. Okay, we already have stock there, and those are just examples of current assets. And examples of current liabilities include accounts payables, include loans, and also accruals. You can add accruals there. What is an accrual? To accrue is to let something compile. So for example, you haven't paid your rent in the last 6 months, so your rent has accrued. Mulinankongole, which has compounded or has accumulated over a period of time. So it is accrued because it has accumulated over a period of time, and that's something that you need to be able to pay within 12 months. Let's now talk about non-current assets. Okay, non-current assets and non-current liabilities. Let's start with non-current assets. Okay, assets. As you may already guess, these are long-term. Therefore, their use must be for more than 12 months. Examples of non-current assets include machinery, vehicles, long-term investments. What does this mean? It means that you may have gotten 20,000 kwacha and invested it on a farm somewhere, but you intend to get back money, to make money over a period of more than 12 months. So that's what's going to make it non-current. Okay, but I must mention that non-current, I think the example I gave is not the best example, because it must be fixed assets. They are fixed assets, and potatoes are not fixed assets. I give an example of potatoes. So it must be like motor vehicles, because those are things that you use over a longer period of time. And then when we talk about non-current liabilities, non-current, okay, we are talking about things such as deferred taxes. I hope that's the correct spelling of deferred, deferred taxes. So you and ZRA may come together and agree to say, okay, ZRA will pay our taxes over a spread period of 3 years. It's a deferred tax agreement, and therefore, since that's running for more than 12 months, it's an example of a non-current asset. Another example is debt, which you have to pay, say, after 5 years. Okay, it's a non-current asset. Another example that you may wish to consider is what's known as debentures, but I'm not going to talk about debentures here. No one's pretty much going to ask you anything about debentures. So that is it on the classification of assets and liabilities, and that was number 5. We now proceed and we'll be on number 6. What is number 6? We have already, so far we have talked about assets, and we have talked about liabilities. Now we need to talk about capital. Remember, we are breaking down the accounting equation, and the accounting equation is that assets is equal to capital plus liabilities. Let's go to where we're supposed to be on number 6, where we are now going to talk about capital. What is capital? Like you already know, capital is money that is used to begin a business. Capital, when we talk about capital, we break it down into 2. There's what is known as capital revenue, and this is usually used to, on the flip side of things, to when you're talking about what is known as revenue expenditure. And let me explain. Let's get back to this one. So capital revenue is money, right, that you use as a business to purchase assets that you're going to use over a long-term period. To purchase assets to be used, right, to be used over a long-term period. Examples of these assets are machinery. That's just one example. So when you get money to buy capital equipment, such as machinery, that is what is classified as capital revenue. Like I said earlier, when we are talking about capital revenue, there's always another topic which comes up, which is that of revenue expenditure. What is revenue expenditure? Revenue expenditure refers to money used to maintain use of capital equipment. To repeat, revenue expenditure refers to money that is used to maintain capital equipment. And these equipment, remember that they are fixed assets. And so when you get money to maintain that machinery, that is what is known as revenue expenditure. In fact, the word itself, expenditure, means that you are using money for specific activities. What activities are these? These are activities that are about maintaining the use of capital equipment. Let's proceed to number 7. Remember, I say that I'm only going to run you through 8 fundamental points for now. And we're now on number 7. Number 7, let's talk about books of prime entry. Books of prime entry, or books of original entry. Is that? Yeah, books of original entry. You get the idea. Now look, listen. Why are they called books of prime entry? It's because they are books where you record the first instance information that you get from a customer. So a customer can come to your business, and at that particular point of interface, they may make orders of particular equipment or pay for particular products that you have to offer. You are going to get that information presented by the customer, and also information as is provided by yourself as a business. For example, you are going to provide the specifications of the pipes that they are buying, or the blocks that they are buying, the total amount, including the unit price for each block. Maybe it's 4 kwacha. That 4 kwacha multiplied by 200 or 1000 because I've bought 1000 blocks. So that information is what is going to be entered in what's known as books of prime entry. Examiners may ask you what a book of prime entry is, and I've just explained that. Further, they can ask you to identify different types of books of entry, and I'm going to list them down. Number 1, there's what's known as a sales day book. Number 2, purchases day book. Okay. Number 3, sales return day book. Number 4 is purchases return day book. Number 5, cash receipt book. Number 6, cash payments book. Let me quickly highlight what's involved for each one of these. For the sales day book, this is where you record credit sales. Purchases day book, you record credit purchases. You've also bought on credit, so you need to record that. Sales return day book, this is where you record returned sales, just as the name implies. But let me explain a bit. Imagine people have come to buy from you, then 2 days down the line they bring back what they bought for you. They could bring it back because it's faulty. They could bring it back because what was delivered to them is not what they specifically ordered. So products can be returned for a number of reasons. When these products were bought from you and they are returned to you, that transaction, whatever is involved, is what's going to be recorded in the sales return day book. The purchases Return daybook is where you record returned purchases. So as a business, you may also have bought and you're taking back. That information must be recorded. It is recorded in the purchasers return daybook. Then there's the cash receipt book, and then there's the cash payment book. And I think you can guess what's involved. So I'm not going to complete this part. I'll leave it to you. Let's move on and get to number 8. And remember, I did mention that I'm going to run you through 8 fundamental points, and we are on the last one. The last fundamental important point you need to understand is that in accounting, there is what is known as the double entry system. The double entry system. What does this mean? It means that for every transaction, there's going to be double entries. For every transaction, there's going to be double entries. And let's look at an example. But before I talk about the example, these entries are going to be categorized as debits. In short, it's written as DR, like that, and credits, which in short is written as CR. So for every transaction, there's going to be a debit, and for every transaction, there's going to be a credit. I will explain this shortly. Let's look at an example. An example is you as a business, you get 75,000 kwacha from bank to purchase motor vehicle. So 2 files then have to be opened, and I need you to just look at this as having files on your desk. What files are we talking about? We're talking about a bank file and a motor vehicle file. Motor vehicle file. So this is what is meant by double entry, that there's always going to be 2 files or 2 accounts that are involved. And for each one of these files or accounts, one is giving out and the other one is receiving. By receiving, let's look at the same example. The motor vehicle file has received a car, magula motoka, worth 75,000 kwacha. But this money came from somewhere. That account that is giving out, in this particular case, bank has given out 75,000 kwacha. A debit is a recording that indicates that an account has received. So debits, okay, refers to receiving. In other words, always debits the receiving account. Credits refer to giving. Therefore, always credits the giving account. Are you following? You need to follow. If you are not clear, ask me. Ask me where you're not clear in this particular case. Ask me. You need to be clear, and these fundamentals are very important. So the double entry system entails that there are going to be two recordings. Like in the example that's given, there's going to be bank and motor vehicle. The bank account is giving out 75,000 kwacha. Because it is giving out 75,000 kwacha, it is going to be credited. Motor vehicle is receiving 75,000 kwacha, therefore it is going to be debited. Always debit the receiving account, always credit the giving account. Something else about the double entry system is that there has to be equal amounts. Let me explain. Remember that how much did we get from the bank? We got 75,000 kwacha from the bank. It therefore means that even in the file for motor vehicle, the account for motor vehicle, there must be 75,000 kwacha. If there is less, then kulinakawala alai. Atenga ndarama 75,000 kwacha, but a spending ache 50,000 kwacha. Meaning where is the 25,000 kwacha? Double entry system implies that number one, there are two recordings. And number two, the recordings ultimately must be of equal amounts. And this is very important. These are the 8 points that I sought to present before you in this particular lesson. So let's run through them together. Let's highlight them and run through them together. The first one was on the purpose of accounting. That accounting is important for a business to be able to have information, financial information that can be used for costing, for pricing, for investment prospects, and also for auditing. The second point was on the accounting equation. That the accounting equation entails that assets is equal to capital plus liability. And that is all that you need to know. Number 3, I talked about what assets are, and I stated that assets are what a business owns. Examples: machinery, stock, motor vehicle, trade receivables. I then moved on to number 4, where I talked about liabilities. And liabilities are what a business owes. Munangongole, you owe. Examples: loan, trade or accounts, payables. Number 5, I talked about the classification of assets and liabilities. And they will fall under 2 categories. Current assets. Should I have said current assets? They will fall under current and or non-current. That therefore means that you have got current assets and current liabilities. The principle for both is that it is something that must be dealt with within a year, within a period of 12 months. The other classification, non-current, it means that you have got non-current assets and also non-current liabilities. I then proceeded and I talked about capital, and specifically narrowed down into what's known as capital revenue and revenue expenditure. Number 7, I talked about books of prime entry, and these are the ones that are listed down here. This is not a complete list, but it gives you a foundation. There could be 2-3 more other books of prime entry, but these are at least for you to understand that books of prime entry are those books where information is going to be entered at the first instance. And number 8, I talked about the double entry system. As we move on in our studies, we will make reference to these particular fundamental points that I have raised. In the next lesson, I am going to start teaching you on how to enter information according to what ZIM requires, and I will with you review some past exam question papers. My name is Savoy, and I'll be happy to take you through your studies. This is my nice name. It's a unisex name. So some people ask me, oh, isn't that a girl's name? I was like, yes, it is, but it's a unisex name. So you also have men. I'm not a boy. You also have people by that name. And my number is 0966930260. Goodbye for now.